and welcome to today's discussion, Charting the Course, a New Landscape for Your Nonprofit Organization. My name is Jordan Forney, and I'm a financial advisor at Bernstein, a global investment management and research firm. Our firm's dedicated to serving the nonprofit community, and my practice based in the Mid-Atlantic focuses on partnering with tax-exempt organizations and their respective executive leadership teams to help them meet their fiduciary responsibilities. Today, I'm grateful to be joined by two people that I hold in high regard. Alexander Reed, partner and team leader at Baker Hostetler in their tax-exempt organizations and charitable giving group. And my colleague, Claire Galla, National Managing Director and head of our centralized foundation and institutional advisory group at Bernstein. So thanks to both you, Alex and Claire, for joining us here this afternoon.
Thanks for having me.
Of course. Together, we want to first acknowledge the challenge that the past 2 years has been for nonprofit executives. And that really is the impetus for us coming together today in an effort to be a resource for all of you. And over the course of the next, call it 45 minutes, we really hope to broach some of the common concerns that we've seen across the country in our recent dealings and share best practices as it relates to navigating today's challenging operating environment. So before I turn it over to Alex and Claire to formally introduce themselves and talk a little bit more about their practice, I of course have questions to ask them here this afternoon, but do want to encourage engagement from the group and want this to feel as much of a dialogue as possible. And I mean it when we say, and I'll speak for Alex and Claire to say that what's important to you is important to us. So we certainly want to maximize your time here today. So with that, thank you all again for joining us, and thank you, Claire and Alex, for being here. Alex, wondering if you want to tell the group a little bit more about your practice and areas of expertise before we jump in.
Sure. Thank you so much for that introduction. Honored to be here, and thank you all for joining us this afternoon. So I'm a tax specialist focused on nonprofit organizations. I've been practicing in Washington for a few decades now, and my practice is really, I think of it as the nonprofit sector writ large, rather than any particular sub-segment within that sector. Nonprofits as a sector have common regulatory requirements applicable to them, and many of those regulatory requirements are written in the tax law. As it turns out, the way those tax laws often operate is as governance rules. Ergo, I'm a governance lawyer, but I have to get there through the tax law. So if you find that a lot of the questions that you have about fiduciary questions, fiduciary obligations, and how best can we accomplish our mission implicate the tax laws, there's a reason for that, and it's because the way that the rules apply to you as an organization through the tax law control your governance. And so that's kind of as a very high level what I do. I help all sorts of organizations achieve their mission, whether that is through direct programs or through investments or through different types of collaborative structures with for-profits or other nonprofit organizations. That's structuring those transactions and making them work is what I do. Claire, over to you.
And I promise we'll get into issues that are tax related and governance related. So you used a lot of words that I think people are curious to dig into. But Claire, certainly want to hear from you and your role overseeing the group at Bernstein.
Yeah, absolutely. Thanks, Jordan. Yes, Alex, tough act to follow. So I have a great job at Bernstein. I always joke that I have the best job at the firm. I oversee our foundation and institutional advisory practice. So our team really partners with Jordan and other advisors across the firm to work with about 900 foundation and other tax exempt clients. That's healthcare, education, advocacy, social services, membership associations, and the like. It's really a diverse mix. The one I'd say sort of the thread of connectivity across our clients is that they tend to operate with volunteer boards of directors, very expert but lean executive teams. And our clients tend to look for not just an outsourced chief investment officer, but really an overall strategic financial partner. And oh my gosh, over the last 18 plus months, we have covered a lot of ground and advised and brainstormed on lots and lots of different financial issues together. So glad to be here today. Thank you.
Yeah, thank you guys both. And hopefully that sets the stage and provides some contextual background information for the group for how we're going to go about this. And we certainly identified some pervasive themes leading up to this that we hope to dig into. And just to jump right in, one of those themes is certainly governance. And now is the time, anecdotally, that investment committees are getting together. And they're meeting right now as we go into the end of the year. And so one thing that has come up is looking at key policies during those meetings. And so just starting with you, Claire, why is it important to look at those key policies and to update investment policy statements with frequency?
Yeah, look, I always think of the investment policy as the roadmap, right? That's the overall guiding force behind the overall investment program for any organization. The spending policy is integrally related, right, to the investment policy as well. And so, look, we always recommend that, once a year, the committee really do a deep dive review. It doesn't mean you're always going to change, or edit the investment policy, but it's important as a part of your, your responsibility overseeing the assets of the organization to do that review with your investment partner. These days, in this environment, we are certainly going that extra step, and we are making adjustments to different investment policies and spending policies. It'll be interesting to hear Alex's take on that as well. But it's really two primary reasons today. The first is, look, we're at an incredibly dramatic shifting point, right, in the economic backdrop, in the market backdrop for organizations. And so for all investors, we're looking at a historically low interest rate environment with, in all likelihood, rising interest rates to come, a resurgence of inflation, right? So inflation risk is here again. And of course, a decade that we're on the heels of a decade of really strong market, returns with equity. So shifting market environment, definitely a time for organizations and fiduciaries to look at expectations prospectively around returns and risk and also spending, right? So that's one thing. The other is, over the last 18 months, right, we as a culture, as a country, have experienced a racial justice reckoning in a way that we haven't really seen since I'd argue since the civil rights movement in the 1960s. And that has resulted in many foundations and other nonprofit organizations stepping back and in evaluating their institution and saying, how can we holistically align our enterprise with our mission, vision, and values? In many cases saying, how do we better reflect our value of being an anti-racist institution across all of our policies, including our investment policy? How do we write that in? How do we institutionalize that, provide some institutional memory? So those are two areas where, changing the way you invest and think about investing are really important.
Okay, thanks, Claire. Alex, it looks like you have some comments there.
Yeah, no, I loved that. I love the way you presented that, Claire, and agree wholeheartedly that the need for nonprofits to walk their talk in every aspect of the organization is really important. I like to think of nonprofits as little moral theories, that they are trying to accomplish something, some objective in the world, some theory of change that they want to see. And governance is effectively the means by which they achieve that mission, right? So governance is, in many respects, the productive output of a nonprofit organization. And the investment policy is as much a part of the organization as its direct services that it conducts to achieve its mission. So it's extremely important to look hard at the way that the organization invests its funds, both to make sure that it's doing so in a manner that's consistent with its purposes, and also that it does so in a way that is prudent. We're going to talk about that word prudence a lot in the governance space, because it really is, it has a concept of time to it. What do I need to do today to make sure that the future is the future that I want to see? That's really the exercise that you're doing, and investing and looking at the way in which you invest is an extremely important part of that. Am I doing things today to set up the right amount of purchasing power in the future, right? That's the inflation concept, that I need to make sure that I can still buy the same amount of stuff in the future as I can today. I need to preserve that. I need to have enough income in the future to support the programs that I anticipate having in the future. And then what's very curious about governance in a nonprofit organization is they don't die. Nonprofits live forever. They're perpetual organizations. And so unlike we humans, we mere mortals who, we have different phases of life. We retire, we save for children. We have different planned life events that we can anticipate. Nonprofits, can theoretically go on forever. So that prudential timeline is infinite, right? So how does that impact the strategies that I choose today for my investment policy?
Very helpful, both Claire and Alex. Thank you. And I do think we will talk a little bit more about the specifics as it relates to some of the investment headwinds that you referenced, Claire, and what that means for investing a portfolio today that may look different from years past. And Alex, to your point, that governance is all encompassing, right? So I think that keep bearing that in mind when not only running these meetings, but of course, at all times when running your organization, certainly helpful to think about there. So one thing that's a little bit interrelated to this initial topic that has also come up is, and it's a good problem to have, but organizations that have cash or a surplus. And whether that's because they couldn't spend money or they were making cost-effective adjustments to how they were operating their business, the reasons are varied, but it certainly is as I'll call it, a good problem that some organizations have found themselves in. And so, Alex, I'll just stay with you because I know you had referenced talking with organizations about even repurposing funds and what that may look like. But what's your experience been in working with organizations that may find themselves having a surplus?
Yeah, it's an interesting question. I like the way that you posed it, because part of the issue is sometimes you have extra cash because of a misfortune. Namely, COVID prevented a lot of in-person activity. And over this past year or two, many organizations have been unable to deploy their funds in a way that they're accustomed to spend on in-person events and direct services. At the same time, the investment climate has been pretty favorable, at least in the stock market, over the past year. And so there've been a lot of excess returns or surprising returns in many endowments. So how do we rate our endowment is a question that comes up. Of course, the answer is not, you don't raid the endowment, you prudently spend your endowment. But you do, one of the issues that you have to confront when looking at what you can spend and what you can take from it is, where did those, you have to source, where do those funds come from? Were they restricted? And that's going to raise our first and favorite acronym for the day, UP MIFA. It used to be called UMIFA or UMIFA, depending on your region of the country, I guess. And it's the Uniform Prudent Management of Institutional Funds Act, which is adopted in all states except Pennsylvania and Puerto Rico, which isn't a state, but and what it says is that you have to pay attention to what your donors have the restrictions that your donors have placed on funds, and you have to. But we're going to set some standards for how a fiduciary is considered to have discharged their duty in investing those funds, so that Wyoming doesn't tell Oregon that the trustees in Oregon have made a mistake and breached their fiduciary under Wyoming law, and vice versa. So trustees of funds that are restricted and unrestricted can be confident that they are prudently overseeing those funds.
Very, very helpful. Thanks, Alex. And Claire, we've been brought into situations where in some instances, this may already be an established endowment that has an investment policy statement, but there's the other side of the coin too, where we have this cash, invest it. Can you talk a little bit about the process of thinking through creating an investment policy statement, and maybe also just talking about those that do have cash on the sidelines and how we're thinking about that? I know it's two very different situations, but I think relevant to this dialogue.
Yeah, look, I think you're right. I mean, Alex just nailed it in terms of a lot of organizations did some really great contingency planning over the last year, given the trauma of 2020, and felt like, oh my gosh, we don't know what's going to happen next. And so we really need to, make some adjustments here on the spending side. And in many cases, folks just couldn't deploy cash because of being remote, because of the environment we were in. And long story short, after a fundraising season at year-end that ended up being much stronger than many anticipated, as well as relief like PPP loans, for instance, right? Many organizations found themselves with a sizable cash balance. And interestingly, in a lot of investment policies, there's great guidance in terms of what to do with the investments once they're there, right? Even if it's regardless of whether it's endowed, true endowed funds, or it's sort of a quasi endowment, right? A board designated, a long horizon fund. But what many investment policies don't provide guidance on is, when do you actually move money into that long horizon, sort of discretionary portfolio? And that's where a number of organizations have really been scratching their heads. And so right now, we've got organizations sitting on a lot of cash, and the cash is earning nothing because we're in a zero interest rate environment. It's losing its purchasing power, right? Day by day. We've also seen this surge in inflation, which, by the way, we think some of that is transitory, meaning supply is just catching up with demand as the market reopens or the economy reopens. But inflation is back, right? There's no question about it. And so one thing we've been advising organizations on is really looking strategically at what access do you, how much cash do you have and how much access to cash do you have, whether it's a line of credit, the ability to borrow based on your investment portfolio, whatever it might be. And what are those bare bones expenses? Let's look at your cash flows. Every organization is different. Everyone has different revenue streams and different calendars, but let's really make sure that we have enough cash, but not too much, right? And try to earn something, at least keep pace with inflation on any excess cash. So we've been doing a lot of sort of deep dive with organizations into their different revenue streams, timing, that sort of thing, to make sure that we're aligned, and really thinking about what's the rationale. When is enough cash enough and we can move more into some sort of intermediate or longer horizon discretionary fund. So that's how we're thinking about the cash. The other piece that you asked, how do you think about building out an investment policy? That leads to, I think, another conversation or another issue we've seen quite a bit of, and what's keeping us very busy. And that's organizations that are receiving much larger gifts, what I would term sort of game-changing gifts, that, they're sitting on multiple millions of dollars, and they don't have an investment policy. They don't have an investment committee. They don't have the infrastructure there. So that's the other place where we're partnering with organizations.
Yeah, and do you think, I guess, going off of that, Claire, how have philanthropists like the Melinda Gates, McKinsey Scotts of the world changed the game, if you will, as it relates to these large gifts? Because that is a theme. We have worked with organizations that have received these gifts.
Yeah.
What can you talk about the work that we encourage leadership teams to do in anticipation of, although sometimes there is no in anticipation, you get an email and you have $5 million. What are you supposed to do?
Right. It depends. Everyone hates that answer, but don't do anything right away. That's like my number one. Like just breathe for a moment and celebrate the manna from heaven that people are describing. But it is this sort of blessing and burden situation, right? So number one is, I think, I always lean on, building that roadmap, right? First of all, you have to have, the biggest challenge, I should say, for so many organizations who have received very, very sizable gifts, in the last year and continue to receive these gifts that may not have an investment portfolio already, is how do we build out a plan and build out the infrastructure so that we're not only doing what's right and in the best interest of the institution and our work today and in the future, but also maintaining our integrity as an organization, our authenticity. Who's at the table in terms of the decisions that are made? How are we building out the policies? How are we making the decisions? So it's really, and what's in that investment portfolio once we're ready to invest. And so there's sort of all these layers, like peeling back the onion, right? In terms of making sure that how we build this is in line with who we are, what we believe. Again, I'll go back to that sort of mission, vision, and values. And so the way that we've actually been asked to provide educational workshops for a number of organizations that are finding themselves in this really great, position right now on what does fiduciary duty mean? And to Alex's point earlier, in terms of, thinking about prudence, I'm thinking about strategically what portion of these funds makes sense for us to spend today and what portion makes sense for us to spend in the long term, and being, really stewards of these assets on behalf of the community. What should we have in place in terms of an investment committee? What does an investment policy look like, and sort of the key, the key elements of that, and really providing sort of the flexibility, but enough structure to help us start to move on that.
Yeah, thanks, Claire. So we have these transformational gifts. We have a very strong giving year that was 2020. We have year-end appeals starting now. And so it leads me to think about some of the changes in the proposed tax legislation. And because you brought it up, Alex, I can't go today without at least talking about it a little bit. I promise I won't make you offer the crystal ball kind of outlook, but what are you paying closest attention to right now as it relates to the proposed legislation? And this is in real time, right? The articles are coming out in the Wall Street Journal today. So what has your attention?
Well, it's a really interesting time right now. It's very demoralizing, I think, for a lot of folks on the Hill, because they were hoping it would be easier. I'm hearing that in many respects, this legislative session has been harder than the 2017 tax bill, which was sort of famously hard. The objectives of raising the amount of revenue under the particular parameters of the 2017 Act were in the time frame that they had. It was such a compressed time frame. Many people said that was, mistakes were made. We did the best we could, but it was impossible and we don't ever want to do it again. And yet here we are, it's 2021 and we're doing exactly the same thing. Part of the reason is because of the budget reconciliation process. And I liken it to, many of you have heard me use this analogy before, but I liken it to backing a semi tractor trailer into a compact parking spot. So the compact parking spot is the number that the budget committee will set for how much revenue the legislation needs to raise and how much it can spend. And then after you've figured out the number, you back into it using tax legislation, which is a lot harder, to predict exactly how much you're going to raise or lose using tax legislation. You have to build an economic model and rely on that and the various tweaks in the legislative language to get you that magic number. So that's what's happening, and it's very hard. The Joint Committee on Tax and their economists are working around the clock right now trying to figure out how to meet all of these different objectives. And of course, the hardest part is that the principals aren't agreeing on the basic framework, how the overall size of the package and how much it's going to raise versus how much it's going to spend. But without those numbers, it's very difficult. So crystal ball wise, the only thing we can be certain of is that the overall tax burden will increase. And most likely that will be a combination of corporate and individual tax increases. And it will be borne progressively. So there will be a higher income individuals will pay more than lower income individuals. But apart from that, I can't say too much. I mean, there's been a lot of talk about attempts to capture capital gain, including most recently what was called a buzzer beater shot by Senator Wyden to impose a tax on billionaires. This particular version of it, so even the language for talking about it is loaded. So do we call it a wealth tax? Do we call it a capital gains tax? Or do we call it an income tax? The big issue is, it's not clear that wealth taxes are constitutional because the Constitution only talks about income taxes in the 16th Amendment. And the problem with taxing investment assets is that they don't always get realized. So if I am Elon Musk and I have a share of Tesla stock that's worth $1 and now, or that I bought for $1 or that I got founder stock and now it's worth 1,000, all of that built-in gain accretes to my wealth. I am wealthier as a result of that, but I haven't sold the stock yet. I'm still holding it. So even though I have that wealth and I can borrow against it, I can do a lot of things and use the power of that wealth in the real world, I have not reduced that gain to something that is considered taxable income. And I have the choice of when I want to do that. Do I hold it until I die and have my heirs realize it? Do I give it to charity and have the charity sell it and realize that gain? Or do I sell it myself? So these are the hard questions of how do you capture and regularly tax that type of increase that the policymakers are wrestling with. They would really like to try to tax it, but it is very, very difficult to do so. So Senator Wyden's proposal yesterday, I think, is already considered dead on arrival. Representative Neal in the House Ways and Means Committee has said that it doesn't look like that one is going to fly. And Senator Manchin said that he's opposed to it, which also basically means that it's dead. So those, I think as a general matter, those efforts to tax capital gains on a mark-to-market basis or tax wealth are not going to make it into the final draft, which is being worked on right now by the Rules Committee. I think that capital gains will likely be that there will be an increase in the marginal tax rate on capital gains. There will be an increase back up to 39.6% on incomes for high earners, with the 3% excise tax, sort of like back in the Obama years. I think that the corporate tax will be at 25%. And in addition, we'll agree to this global minimum 15% tax. So even if you've managed to use tax strategies to get your overall tax burden below 15%, there's going to be a minimum sort of book tax that will cause all corporations to pay 15%. And that will be the kind of final resting place. I don't think we'll see a lot of buzzer beaters on this one.
Yeah, so we'll try to stay in front of all that and be proactive in providing guidance to our clients as things evolve. I think without a doubt, it's going to influence giving strategies as to how this shakes out. It's just, we don't know where we're at just yet. But I think, Alex, that's about as eloquently as I could have put it as to where we're at today. And I appreciate you rendering your opinion as to how some of this
Sure.
may, in fact, play out.
And this is recorded, so we'll come back to it.
That's right. That's right.
Good, I forgot about that.
I intended to make that reminder at the end, but now we'll make sure to play back right around this time and see if you're on or not.
Well, just one more comment on the tax stuff is that the tax cost of giving. So that we talk about the cost of giving, it goes down when tax rates go up. So we know that with the expectation that tax rates will go up next year, the cost of giving should be less next year than it is this year. So perhaps that will push some giving into the next year that would otherwise have been made this year. At the same time, you have a lot of potential changes to the estate tax, potential, these terrifying wealth taxes if you're a billionaire, and other sort of existential changes that might cause you to push your giving into this year. Also, just simply that it's been a good year investment wise, so you might see more giving that way.
Mm-hmm.
Yeah, that's helpful, Alex, and actually a good unintended segue to it has been good on the investment side. And if you were reading between the lines earlier, it may not be as good in moving forward. And so, Claire, curious, I know because you had referenced it in terms of the investment headwinds with inflation, low interest rates that are going to be rising. Can you talk about some of the specific strategies that we're talking to clients about right now to help combat some of those headwinds?
Yeah, absolutely. And before I even touch on that, I'll just follow up on Alex's comments, and that one thing that we are seeing as a result of the really strong equity market environment, that we're sort of on the tail end of, well, I shouldn't say tail end, we don't necessarily know, is lots of contributions to our nonprofit clients of appreciated securities. We're also seeing, and with our private wealth clients, right, they're making those gifts out of their portfolios as well. So we are seeing a lot of that, even if the threat of increasing, right, sort of capital gains taxes is looming out there. Folks are feeling like, well, right now I'm pretty concentrated, and we're feeling very fully valued on the equity side, and it is time, right, for us to move some assets over. And eliminate those, those gains or, the tax implications on my portfolio. So we're definitely seeing that. Yeah. Looking ahead, as we're having conversations with foundations and nonprofits, foundations really struggling, private foundations, with the fact that they will be, continue to have that 5% minimum distribution requirement looking ahead. And organizations who just have programs that are relying on, right, the distributions from their portfolios, we are expecting to see lower returns and higher volatility across publicly traded markets, your stocks, your bonds, what you would typically expect in the public markets. The largest institutions out there have had I don't want to say the luxury, but maybe the flexibility to a certain extent to inoculate themselves from some of the roller coaster ride of the public markets, because they've had the ability to invest more in a more robust way in private markets, right? Whether it's private credit, private equity, venture, you name it, right? And so you'll see a number of the most, the largest institutions out there always have a very, healthy allocation to the private markets. When we look at, and I know a lot of our clients, tend to be sort of that, sub $100 million, dollar type of institution. Some are accredited investors, but not necessarily qualified purchasers. Some are qualified, meaning they have $25 million or more in their portfolio, but still have liquidity needs, right? Still have these needs. And so the idea of less liquid investments leaning into the private markets, potentially higher fees associated with different types of securities. In the past, looking in the rearview mirror, the trade-offs weren't necessarily that attractive, right? And frankly, in a decade where we saw, the S&P go up and up and up with relatively little volatility versus history, that was the right call, like for many institutions. Looking ahead, however, we really are at a, I'd argue, sort of a pound the table moment where we're saying, you know what, like to maintain the inflation adjusted value of your portfolio over time, if we're expecting inflation to be 2 to 3%, right, annualized, and we are, expecting equities to and fixed income traditionally in publicly traded markets to have lower returns, and you need to spend 4%, 5%, whatever that might be, you're going to have to look at some other types of assets to get there, right? You just are, and that's unfortunately a reality we're all facing. One of the benefits for nonprofits and foundations, really nonprofits in particular, sort of public charities, is income generating alternatives, right? Income producing, securities. You're not paying the income tax on that, right? And so we are leaning into, suggesting that organizations really look at things like private credit, real estate debt, those sorts of things that can generate more income than traditional high quality fixed income to supplement, where that gap is looking ahead, as well as other alternatives. Also, inflation sensitive assets. That's something that's really easy for any investor if you're looking at even tips or treasury inflation protected securities or real assets such as, natural resources, real estate, those sorts of things that tend to perform well if inflation outpaces expectations. So there are definitely some things that we're looking at, and we're suggesting that committees look at, the investment policy, potentially create some space for some other types of assets that maybe they didn't have in the past, and manage expectations around return and spending.
Yeah, thanks for that, Claire.
Yeah.
In the return environment, we're expecting that to be muted, adding those diversifying assets, certainly maintaining your existing asset allocation, but looking at ways to find diversifying return streams, all in line with the advice that we're providing clients right now. Thanks for that. And Alex, I do think in shifting gears quite a bit to maybe a more direct legal question, and that would be probably on the other end of the spectrum of the transformational gifts that we were talking about a little bit more, coming across instances where perhaps a donor has made a financial pledge and doesn't deliver on that pledge, talking about how organizations navigate that sort of situation, because whether it's a liquidity constraint or the trials and tribulations that the past 2 years have presented, like we talked about, whatever the reason is, there have been instances that you had referenced, and just curious to offer your feedback and guidance to the group in those situations.
Yeah, absolutely. So one of the things, this is roughly under the category of donor relations, which is a notoriously tricky and complicated and requires a very sophisticated interpersonal facility, I think, to be able to work with donors. Of course, every nonprofit is competing with every other for attention from donors, and to say that they are the most effective at achieving that particular mission, and that mission is worthy of support. And so there's a competitive element among nonprofits. And then, of course, the donors, they're not allowed to get an economic benefit back, but many of them want some sort of recognition, some sort of acknowledgement, whether it be a naming right or some other intellectual property associated with their gift. And so what do you do when a gift is promised but doesn't materialize? There's this question, because if you pursue the donor too aggressively, you might both fail to achieve your goal of getting that gift and turn the donor off from future gifts. So there's that question of a future stream of donations from that particular donor. In addition, if you become known as an organization that goes after its donors, that's tricky too, because you might cause other donors to be hesitant to give. Legally, it's a really interesting question. It's one that is studied in law schools in contracts law. When is a pledge legally enforceable? The answer generally is that, it's not, unless you have made some sort of detrimental reliance. That's the magic word that we learned in law school. It goes back to a case in Pennsylvania where a university, Allegheny College, began constructing a building on the promise of a gift, and then the donor refused to pay the gift, and the court held that there was a contract because the college had taken steps to its detriment in relying on that pledge, and therefore was able to enforce the pledge in court. That's a challenging thing to do, to actually sue a donor and go into court. But it's an interesting time for that right now, because you can see lots of activity, a lot of promises, and are they actually going to be delivered by year end? That's the key. You got to seal the deal if you're in the development office.
Thanks, Alex. I'm looking down at the clock right now, coming up on the 45 minutes, looking at some of the questions from the group, and one in which that grabbed my attention, which I think lends itself well to hearing from both Claire and Alex, would just be around a year-end checklist. So it's the end of October. If I were to think about a few things, right, instead of everything that we've talked about here today, what should I be focused on going into the end of the year? I'll start with you, Alex.
Sure. Well, so one just general question is, are your investment and spending policies in good order? Have you looked at them recently? Are you following them? Do you need to update them? Do they capture the right stuff? Are they, does the policy apply to all of the funds that you possess, or are there some funds that aren't covered by your investment policy? Do you have a clear investment objective? Has that investment objective changed? Should it change? Have you delegated proper authority to individuals to trade in assets on a daily basis? Have you given them a ceiling amount that they're not to exceed? Should you? What have you given them authority to shift into different types of assets? If you're going to go into some of these strategies that Claire was suggesting, which I think sound great, income producing strategies. Does your investment policy currently permit it? Do you need to amend it in order to do that? So, what sort of other approved investments are on the list, constraints that you might have in your policy? So just, it's a little dry, perhaps, to go back to your governance policies. But as a lawyer, I can tell you that the only thing worse than not having a policy is having a policy that you don't follow. Because if you've adopted instructions and then don't follow those instructions, then you're much more likely to be found in breach of your fiduciary obligations. So that would be a year-end checklist, a good to-do item.
Thanks,
What would you
Alex.
add, Claire?
Yeah, I think, look, it's interesting because the fiscal year is so different for so many institutions that we work with that the calendar year end is applicable for some reasons, but not necessarily in the same way, right, that the rest of us are.
Point. Yeah.
And, you know, like December for me is May for a number of groups that we work with. But I would say that towards year end, one thing I would add to Alex's note is how are we communicating with our various stakeholders, right? So, how are we communicating? How are foundations and grantees communicating, right? But, you know, as we wrap up the year, how are organizations communicating with their donors and the individuals and families and communities, right, where they're doing business and the consumers of their services, alumni, right, for institutions that we work with. I was kind of chuckling to myself about naming rights. My kids are in they're playing high school sports, and boy, naming rights are alive and well at high schools, across the country. So, all of those things, the communication in an environment where we are undergoing and have undergone so much incredible change, right? So on so many levels, communication is critical. And have you communicated with your investment partner, right? Like that, to me, we work so hard, I think, at our firm, and Jordan is a great example of proactive communication, but it works both ways, right? It's your responsibility as a fiduciary to be reaching out to your professional partners, making sure that you're all on the same page, right, as we head into the next year. So I think that communication piece is just, critically important.
Well, thank you both. And I think everyone may very well appreciate having 10 minutes back in their afternoons here. So certainly want to thank everyone for joining us here today. We do hope that you found the conversation to be relevant and helpful. Of course, we remain to be resources after this session. It will be recorded so that we can look at Alex's predictions at some point to check them as to what transpires. But we're here for all of you, and just wish you the very best going into the fall. And if there's appetite for it, we really do look forward to kicking off 2022, getting together with everyone, and hopefully that's in person. So really appreciate everybody joining us here, and hope you found it helpful. So thank you so much.
Thank you.
Thanks, Jordan.
Be well, everyone.
Bye.
Bye.